You may start, sir.
Okay, so friends, good afternoon. Welcome back. Uh, this is your third session of foundation paper number 4, Fundamental of Business Economics and Management. So first, as usual, we will recap whatever the contents we have covered so far, and then we will proceed to the leftover for the day. Today we will try to complete the economics part. So I believe the exchange part, that means everything related to money and banking is left. So we'll cover that and we will have the brief introduction of management. The details of management, entire functions, process and other dynamics we will deal in the last day session. So I'm just very quickly recapping everything and I'll be just doing the fast slideshow so that you can recapitulate whatever we have discussed so far in last two sessions. So let's start. We talked this was the weightage contribution of all your papers. Basic concepts 15 marks, forms of market, money and banking, business environment. Out of this, I think in economic section we have covered 3 out of 4. So basic concepts we have covered, forms of market, business environment we have already covered. Money is banking is left, so we will try to cover it today. Okay, and then there is fundamentals of management. So we will also try to have an introduction of management today and the fundamentals part, the detailed concept. Perhaps in the last session we will try to complete it. So let's quickly go through. We talked about the definitions of economics. What does it means? The entire process, the flow, meeting the unlimited needs with proper efficient utilization of limited resources actually is the process of economics. Then we talked about some of the important definition that you as a student must know. So we discussed about wealth definition and Adam Smith and JP say their work. We discussed about welfare definition, scarcity definition of Robbins, and then growth definition of Keynes and Samuelson. I think we talked about their work. Their publication. You should remember all this years and the name of publication in which all this definition had been given by the respective individual. So all four definition is something that you must remember always. The most dynamic one is the growth one because it does not only considers economic as a process of meeting end needs for in today's context, but it also considers, you know, the conservation of the resources so that the future generation may able to satisfy their entire needs. So we actually today when we talked about economic is more about growth. The economics in terms of growth definition. Keynes and P. Samuelsons were the people who were responsible for this. We then talked about the process of economics. Whenever we go through the process of economics, there are three central issues that we need to address: what to produce, how to produce, and for whom to produce. I think we discussed about all this. Then some concepts, which are some terms which are important for understanding the economic theory. Goods, the difference between the goods in layman's understanding and as an economist. The goods for us is the goods which can be exchanged, not anything. So anything which has a saleable value, anything which can be exchanged in return of something can only be called goods for us. For layman, goods is anything that they consume. So goods could be anything. In goods, we also include services. Utility, we discussed about it. It's the degree of satisfaction that a consumer gets after consuming a good. That's we call it as utility, marginal utility, incremental rate of satisfaction after adding one more unit of consumption of any goods or service is what is called marginal utility. Total utility, it is the rate of satisfaction of all the units of the goods that we have consumed at a given point of time. So we discussed about all these terms. These are very important. Then we talked about Alfred Marshall's law of diminishing marginal utility, which states that after uh, every additional consumption of every additional unit of any commodity, its marginal utility declines. Initially, it keeps on declining, and then after some point, it goes to negative. That means this is the point which is the point of reference for all economists or producers to understand that now no more demand can be generated in the market because people are not getting any utility. Even the utility, marginal utility has gone in negative. And this is the point from where the total utility of the consumer starts declining. So we talked about this curve and the description of law of marginal utility. We talked about the assumptions, what Marshall considered the factors to be constant, which actually are not, are called assumptions. So assumptions are all goods and services are homogeneous unit and of size, which always is not possible. Their time remains constant. That is not true with any consumer. You can consume one thing today and you would definitely like to, consume it more tomorrow. But if today at given point time of consumption, you want to increase it, then only the law of marginal utility will prevail. Tomorrow, your rate of satisfaction may increase. So these are some of the assumptions which Marshall considers while framing the law of diminishing marginal utility. Then we talked about exceptions. What are the goods and services which do not follow the law of diminishing marginal diminishing utility? These are the consumption that we do for collection, for hobby, for our misery, money and gold. Now these are the goods and services for which uh, diminishing marginal utility law does not apply. We talked about what is the significance of having the understanding of law of diminishing marginal utility, because this is the law which only gives us the value paradox. That means what a goods and service have the maximum utility, how much price, how much value is associated with any goods or services. This is the fundamental law for all the remaining law of economics, whether it is law of demand, law of supply. The fundamental law remains, the law of diminishing marginal utility. Uh, Diminishing marginal utility law also helps the regulators in terms of framing taxation and proper wealth distribution. And above all, law of diminishing marginal utility for a producer, from business sense of point, this is one of the major tools, the most significant tool for forecasting demand of any goods and services. So this is a fundamental law that as a student of economics, you always must know. Then we talked about demand. What is demand? And we talked about demand from economics point of view, not from layman's language. For layman, demand is anything that I want to have. Anything that is my desire can be called as demand. But for economists, demand is always backed by purchasing power. I may have desire for 10 things, but I don't have money to buy all those 10 things. Then these desire of 10 things cannot be called as demand in economics. In economics, demand is only those desire which for which a consumer or which is backed by purchasing power. So if I have a demand of X and I have money to purchase that X, that can be called as demand. But if I have a desire for Y and I don't have the sufficient money to purchase it, then the Y desire cannot be called as demand in economics. Now, what are the determinants of demand? It is the price of the goods, but naturally, when we are talking about demand, which is backed by purchasing power, then price is the most important determinant of demand. Price of relative goods, and the concept of relative goods, if you remember, we talked about there are two types of relative goods, complementary goods and substitutes. Complementary means um, two or more commodities which complement each other's utility. We talked about the example of motorcycle and fuel, then tea and milk. Uh, and what is substitute goods? Substitute goods which substitutes the utility of any other good. For example, bicycle and motorcycle. Now both can be substituted for each other, right? Coffee for tea, train for aeroplane for traveling purpose, etc. and so forth. So the price of relative goods also determines the demand of any goods or services. Then we talked other determinants, income. Income means the income of the population, the consumer. If they don't have the income, or if their income has increased or it has declined, it have the respective impact on the demand. So income impacts the demand. We talked about taste and preference. Suppose I am habitual of having a type of dish every day, and tomorrow I develop a taste for something else. I'm a vegetarian, and day after tomorrow I develop a taste for non-vegetarian. Now, as soon as this taste and preference of consumer changes, the demand of commodity also changes. Then population, if the population of the entire market, population of the entire territory increases or decreases, it also impacts the demand. And the weather condition. So these are the determinants of demand. Then we talked about one of the fundamental law of business economics, that is law of demand. law of demand of any goods or services speaks about the relationship between the quantity that can be demanded at any given point of time in a market vis-a-vis the price of that commodity. And what the law states, both the price of commodity and its quantity demanded shares inverse relationship. What does it mean? It means if the price increases, demand will decrease, and if the price decreases, the demand will increase. So as depicted in this curve, in this graph, you can see the price is increasing and demand is decreasing, and the price when it is reducing, the declining, the demand is increasing. Okay. What are the factors of price of law of demand? The prime factors are price of commodity, because it shares the relationship between price actually. So the most significant factor of law of demand is the price of commodity. If the price increases, the demand will shrink, and if the price decreases, the demand will expand. Then the income of the consumer. So even if the price is increasing and the income of consumer has also increased significantly, then the demand may not follow the law as stated. So income is also one of the important factors, and taste and preference. Why we are talking about these factors? Because law of demand, when we are talking about the law of demand and the relationship between the price and the quantity demanded of the goods and services by the consumer, having the inverse relationship, it happens only if these three factors, price, income, taste, and preference of consumer are constant. If there is any change in any of these factors, then the law of demand will also change. Okay. Then we talked about what is market demand and what is individual demand. By individual demand, we mean the demand of one goods or services of one consumer. And by market demand, we mean at any given point of time, the total demand of all the consumers, all the individuals who are there in the geography, in the market, what is the penultimate demand of the entire market. So market demand at different prices gives us market demand schedule, and individual demand at different price level gives us individual demand schedule. As a business economist, we are more interested in market demand schedule, not in individual demand schedule. Then why individual demand schedule? Because the constituent of market demand is individual demand. Now, what are the causes of falling demand? Why this demand, falls when price increases, or why demand rises when price is declining? It is because of the factors which are called as causes of falling demand. The first one is diminishing marginal utility. Now, you need to understand since marginal utility of the commodity, keeps on declining, and if on top of it, if you increase the price, why consumer will purchase? Then the substitute effects. Now, for every utility, we don't have just one goods. We have many goods. If you are hungry, you are not dependent only on the rice. You can eat chapati also. So there are substitutes available for literally every needs, every utility. Now, because of availability of the substitute, if the price of X good increases and the price of Y goods remains constant, then consumer will tend to, buy Y instead of X. So the demand of X will reduce, and vice versa. Okay. Then income effect, bias population, these are the causes of falling demand. Then we talked about certain exceptions where law of demand do not, follow the inverse relationship with the price. Now these are Giffen paradox. By Giffen paradox, we mean the essential goods, all those goods and services which are 100% necessary for the living existence of human being, existence of consumer. Now, in that case, even if the price increases, there will hardly be any impact on the demand. Okay, so they do not follow the rule of the law of demand, that price will increase and the demand will decrease, and vice versa, because these are essential goods. So we talked about Giffen paradox. This is what is called Giffen paradox. And speculation, consumption, shares or speculation. Now these are the goods and services which we purchase just for the purpose of either status or having a false illusion that this good is very good, or shares for future, expecting profits in the future. Now, in all these cases, the law of demand will not prevail. Even if the price increases, people yet will tend to buy it. Okay, so these are certain exceptions. Then we talked about Veblen idea, Veblen effect. Veblen effect means when we have a false narrative, false notion that a product coming from X company or Y company or coming from X state or Y state has the premium outlook, right? Like in case of mobile, even if the price of iPhone will increase, people will tend to buy it. Why? Because they have a false idea that this is the most secure one. Nothing will happen to it. It has its own operating system. For example, let's see some electronic goods or so, let's say some automobile. When you purchase Mercedes, even if the price is increasing, you have a false idea this is the most secure one. So these goods do not follow the law of demand. We call this effect as Veblen effect. Now let's talk about the classification of demand. Now demands are of three types: price demand, income demand, and cross demand. What is price demand? Price demand, we mean by price demand the relationship of goods demanded vis-a-vis its price. What is income demand? Income demand means the relationship of quantity demanded of goods vis-a-vis income of the population. Okay, and the cross demand means the relationship between the quantity demanded and that of relative goods, that may be complementary goods or substitute goods. Then change in demand and demand shift. Change in demand means when there is all other factors, the determinants of demands are constant and the price is showing some relationship between the demand, we call it as change in demand. So it's a slope which is coming from top to bottom at higher price, low demand, and at lower price, high demand. And what is demand shift? If there is any other determinant of factor like income, like substitute goods, if any of those factors has changed, the entire slope will shift either rightward or leftward. So the entire demand schedule at different prices will, change. Now, why it happens? It happens because of other factor other than price, not because of price. So change in demand because of price, we can study it in change in demand, and change in demand because of other determinants of demand can be seen in shift in demand. So the entire demand shift at various prices of the market will shift if there is a shift in the consumer surplus. Average income of the consumer will increase or decrease. The entire demand curve, the entire demand slope will shift either leftward or rightward. But if there is a change only in the price, not in consumer surplus, okay, not in taste and preference, not having anything in the substitutes or complementary goods, then there will be only change in demand. That means the demand will, fluctuate as per the price of commodity. So we know at price X, what will be the demand, at price Y, what will be the demand, at price Z, what will be the demand. The problem comes when demand curve shifts. While we know because of law of demand at price X, there will be demand of 5 unit, at price Y, there will be demand of 15 unit, at price Z, there will be demand of 20 unit. But since the income of the population has increased, so instead of having a demand of 10 at price X, we tend to have a demand of 20 at price X. Why? Because other determinant factor of demand has changed. There is the demand is not changing because of price, it is changing because of other factors. So whenever there is a shift in demand, you can conclude that there has been change in other determinants other than price. And whenever there is no shift in demand, only the demand is changing with change in price, it is because of only price and rest other factors are constant. So we talked about change in demand and change in demand shift. Then we move to supply. What is supply? Supply, in general terms, supply means whatever is available is at any given point of time is supply. But in economics, supply means the goods which producer is willing to sell at any given point. So anything that is available is not, supply. Rather, anything which is available for sale is supply. For example, your mother is cooking food in your kitchen, but she is not cooking this food for sale purpose, but she is cooking the food to feed you all people. So this cooked meal cannot be called as supply. But the same meal when it is cooked in the restaurant, now this cooking is happening because of intention to sell this dishes to the consumer. So the same dish can be called as, dish for the supply. So quantity of goods which a producer is willing to sell at any given point of time can only be called as supply, not everything and everywhere else. So like law of demand, we also have law of supply. Now, what is law of supply? Since law of supply is backed by the willingness of the producer to sell a commodity, so it has a direct relationship with the price. Now, in case of demand, the willingness of supplier was not there. It was the willingness of the consumer. So consumer naturally would like to buy something more at lesser price and would like to buy same thing in less quantity at higher price. But in case of producer, the reverse happens. The producer is always interested in the margin, income, profit. So at higher price, the producer will tend to sell more, and at lower price, producer will not like to sell more. Why? Because margins are less. There is less profit. So law of supply typically follows direct relationship between price and the quantity being supplied at any given point of time. Producers are willing to sell more quantity at higher price and less quantity at lower price. Now, this relationship between the supply of goods and its price is what is called law of supply. Like law of demand, we also have the determinants or the factors of supply. What are those? The prime factor being the price, higher price, more profit, more supply, lower price, less profit, less supply. But is it only price? No, there are other factors. So what are other factors? Price of input. Now, suppose I am as a producer ready to sell my good and at a price at 10 as at rupees 10 in 100 units. But all of a sudden what happens, the input price of input, the raw material increases drastically. So my cost of production increases. Now, as a result, now I am not willing to sell at 10 at rupees 10. I am not willing to sell 100 units. Now I will, I need something more. So these are the other factors. Similarly, technique also plays impact on the supply, weather condition, and sometimes government policy. In every year or time to time, you might have noticed that government uh, gives subsidy or it puts ceiling. Now, whenever these policies are imposed on any product or any type of product, it impacts the supply. Why? Because it impacts the margin. It impacts the willingness of the producer to sell in the market. Okay. Uh, like demand schedule in supply also, we have two type of schedules: individual supply schedule and market supply schedule. What is individual supply schedule? By individual supply schedule, we mean the ability of one producer to sell X quantity at given point of time. Suppose there are five producers who are manufacturing pen. Right now, one producer is ready to sell 50 units of pen at 5 rupees. The second producer is ready to sell 20 units of pen at 5 rupees, and the third producer is ready to sell at 5 rupees, just 5 units. So when we will try to understand the individual supply schedule for first sub producer, the individual supply schedule would be 50 units at 5. The for second, it would be 20 units at 5, and for the third would be 5 units at the rate of 5. So this is individual supply schedule of each producer. But when we look at an industry, then it becomes the sum total. So we sum total all the three units, 50 plus 20 plus 5, it becomes 75. So total producers are ready to sell 75 units of pen at given price of 5 at any given point of time. So it helps us to form the macro policies of economics, how the market will behave, how the entire industry will operate. So for the macro purpose, this individual and market supply schedule is very important. Now come to the change in supply and supply shift. Unlike demand shift and change in demand, we also have change in supply and supply shift. What is supply shift? Other than price, if there is change in any factor of supply, then the entire slope of law of supply will either shift rightward or leftward. It gives us an inference that the supply is not changing because of price, but it is changing because of other factor other than price. Those factor may be price of input, technique, weather condition, government policy, etc. But when there is a change in supply only because of price and rest other factors are constant, then it is change in supply, not shift in supply. So after understanding law of supply and law of demand, Students, you need to understand that these three laws, law of diminishing marginal utility, law of supply, law of demand, these are the fundamental law of economics. So we must be aware about every dynamics of all these fundamental laws. Now let's talk about equilibrium. What is equilibrium? Now equilibrium is a state where supply and demand curve intersects with each other. So it is that quantity and the price where law of demand, that means the total demand of the market and total supply of the market meets. We call it as equilibrium. Now, why it is important? It is important for the purpose of for market dynamics, because the basic fundamental function of market is to determine price. Now, how market determines fair value or fair price? कि इस सामान की कीमत कितनी होनी चाहिए? It depends upon the equilibrium state, the price and the quantity at which both the supply of the goods and the demand of the goods are meeting. That quantity is the equilibrium quantity. That means this is the maximum quantity a market can consume at any given point of time. And what should be the maximum price? This should be the maximum price. So it gives us the price factor. What should be the realistic price where all producer can able to sell all their produced goods? You know, that that equilibrium can be reached only by knowing the equilibrium price and equilibrium quantity. Okay. Elasticity. Then we move to elasticity. Now, what is elasticity? Elasticity means the change in demand or with respect to change in price or any other factor. Similarly, elasticity of supply means the degree of change in supply with respect to change in any factor, that may be price or input cost or weather condition or anything. Now, what are the types of elasticity? There are uh, two types of elasticity. One on the basis of measurement. That means we just do the mathematical calculation of the rate of degree of change of demand vis-a-vis the rate of degree of the price of the commodity, and we get a numerical value. So on the basis of numerical value, whenever we talked about elasticity, it is either unitary elasticity, perfect elastic elasticity, relative elastic elasticity, perfect inelastic elasticity, and relative inelasticity. So there are five elasticity on the basis of the numerical measurement value of the elasticity. Now, on basis of the factors, as you know, for both demand and supply, there are important determinants. So on the basis of factors, the elasticity could be of three types. One, price elasticity. When we check the rate of change of degree of change of demand with respect to rate of change of price, then it becomes price elasticity. When we see the degree of change of demand with respect to degree of change in income of the consumer, it becomes income elasticity. And third one would be the cross elasticity. That means the rate of change of degree of change of demand of X good with respect to any change which is happening to the substitute or complementary goods, Y good. Now that is called cross elasticity. How can you measure? Now measurement can be done by four methods: percentage method, total outlay method, point method, and arc method. Percentage method, simple formula, percentage change in demand vis-a-vis percentage divided by percentage change in factors. For price elasticity, it would be percentage change in price. For income elasticity, it would be percentage change in the income of the consumer. And for cross elasticity, it would be the percentage change happening in the substitute or complementary goods. So we get a numerical value, either 1 or more than 1 or less than 1 or 0. Depending upon these value, we can classify them whether they are unitary elastic, perfect elastic, relative elastic, or inelastic. Then we have total outlay method. Now, what is this total outlay method? Total outlay method means the total expenditure of the consumer of the market, you know, uh, at different prices. So if the total expenditure increases, then it is more than 1. If the total expenditure reduces, then it is less than 1. And if the total expenditure, in spite of change in price, remains constant, then it is 1, unitary elasticity. So like this, we can identify the numerical value even by calculating the total expenditure of the market. Okay. Then point method and arc method. What is point method. By point method, we find the degree of change on the graph itself. We divide the lower segment with the upper segment and we get a numerical value. Okay, and what is arc method? We check the line segment of the change at both the end, price end and the demand end, and then we get the numerical value, whether it is one, more than one or less than one, and accordingly we can classify whether it is unitary elasticity, perfect elasticity or inelastic elasticity. Right. So these were the methods of measuring elasticity. Then we talked about the subject matters of economics. In economics, what actually we do? The economics deals with the four important subject matter. The first one, production of goods and services. So second one, where this goods and services has to be sold, the market part. The third one, how it has to be sold, how it has to be exchanged, so exchange part. And what is the distribution of the revenue that we are getting because of this entire process of economics. So that is what is called distribution. Okay, so these are the four important subject matters of economics: production, market, exchange, distribution, and there are other factors like technique, value, price, and all. So these are secondary or tertiary factors. We are not much more interested in other factors, but we are primarily as a economist interested in production, market, exchange, and distribution. Okay, so this was all first day. Then we also talked about the business environment. Business environment are of two type: internal business environment, external business environment. Internal environment means all the factors that a producer can control, influence, and external business environment means all the factors that producer cannot control. So what could be the internal business environment? Employees, technique, raw material, logistic support, etc. Right? Price. And what are the external environment? The government intervention, political environment, taste and preference of the consumer, income, if there has been shift in the income of the consumers. These are all external environment. How we study this business environment? And there are primarily three ways, and the fourth way help us, for making the strategical decision. So we are interested in these three ways. What is the first one? Pestle. Pestle means the classical tool which help us to analyze the external business environment. It stands for P stands for political environment. We assess the political environment and then we consider what could be the impact of this political environment in my production, in my business. Accordingly, we strategize. Economical factor, we see the GDP, we see the employment status, we see the consumer surplus. All this also may have impact direct relationship on our goods and services in the market. So we also understand the economical environment which is happening at any given point of time in the geography where we are operating as a producer, and then it helps us to adapt with the external change. Then social factors, technological factors, environmental factors, and the legal factors. So pestle means political, economical, social, technological, environmental, and legal. I think we discussed all about this in detail with examples in that session. So need not to stress too much. You must remember all these tools: pestle, SWOT, WCAFU, and POTUS 5-factor. I think when you will move to enter class, you will have a detailed session on strategic management where once again people will explain you SWOT, WCAFU, and the POTUS 5-factor. Okay. Right now, pestle and WCAFU are more important for you to understand how a business or a producer should adapt with the external environment. By proper interpretation, analysis of pestle and WCAFU, the producer can adapt with the external changes and still can operate in the market. Okay. Then we move to the production and market theory. In production theory, we discuss about the various concepts. What is production? What is total product? What is average product? What is marginal product? We also discussed about PPC, PPF, both are same: production possibility curve or production possibility frontier, one of the fundamental frontier which help us to take a decision for the effective utilization of resources, because a resource can be used for many things. Now, what decision should I take to utilize this resource? It all depends upon PPC and PPF. This is what PPC, how it looks like. Then we talked about the production theory. What are the factors of production? Land, labor, capital, organization. We discussed about all the four. Just I told you all people, remember land does not mean only piece of land. It means all the free gift that we get from the nature. And labor does not mean the worker. The labor means the work itself. It is the human effort, not human. But the problem with labor is that you cannot separate work with the worker. So you cannot separate human effort with the human being itself. So capital, one of the fundamental factor which is essential for getting all other factors together. Organization, assimilation, or entrepreneurship, by which we are utilizing all rest of these three factors for set objective. Then we talked about what are the law of production. There are typically two law of production in short run. Short run of production prevails, and in long run production prevails. What is short run production? Short run production means law of variable proportion. That means if uh, all other factors of production are constant and there is change happening only in one factor, then it explains us how the production will increase or will move to the constant and scale, and then it will reduce. So in short run production of any type of goods or service, it is only the law of variable proportion that prevails. You should know this. This is how it looks like. I think I've explained you this in my last class. And what is long run production? In long run production, there is nothing called as variable factor and fixed factor. In long run, everything becomes variable. So you have to change entire scale. You cannot rely on keeping other factors constant and just changing one factor. Now, what happens in long run production? You see three type of return: increasing return, constant return, and diminishing return. And there are reasons for all these three returns. I think we discussed about this. Then we talked about the cost theory. There are three type of cost: real cost, economic cost, opportunity cost. We discussed about all this. We are more interested in economic cost, which is sum total of explicit cost, implicit cost, and normal profit. Then we move to revenue concept. What is a revenue? Revenue is the amount that we get after making the exchange in the market. So selling of the commodity, whatever money it brings is called revenue. Revenue is not profit. You should remember, profit is margin. So revenue is the total income. Okay. So what is total revenue? What is average revenue? What is marginal revenue? These are the terms we discuss about this and their relationship. Then we move to market theory. So what is market? Market in economics is a place where exchange of products between producer and buyer takes place. Uh, what is the function of the market? It has two specific function. It determines price. When I was explaining you the equilibrium portion, then I told you how market determines the price. Okay, the price at which supply and demand meets. That's the market price. It also explains us the supply determination. So what should be the total supply at any given point of time so that consumers are satisfied, their needs are fulfilled. So again, it is the quantity at which the supply and demand intersects with each other. Now, these are the two important functions of the market. Uh, Same graph which we were discussing when we were talking about economies of scale or equilibrium, right? Then we move to the classification of market. The market can be classified on basis of region into three markets: local market, national market, global market. It is self-explanatory, though we have taken the example of all the three and dealt in detail. On the basis of time, you can have again three type of market: very short term market, long term market. We have seen with an example, milk cannot remain, for more than 1 day. So it is a commodity of very short term market, right? Your food grains or your medicine can remain for some short time, but not for long. So it is a commodity example of short term market. Long term automobile or your house. Now you cannot go and purchase house every month, right? So we discuss about all this in detail with example. Then the last one of the market was classification of the market on the basis of perfect competition and their feature. So in terms of competition, we can classify market in two categories: perfect competitive market and imperfect competitive market. A perfect competitive market, we discussed that all products are identical. They are Xerox copy of each other. Now, all such market are called perfect competition market. We talked about its features, Uh, Perfect competition. In perfect competition, the buyer is always price taker, not price giver. That means whatever price will be decided by the market, that price is the only price on which the producer has to sell. The producer cannot dictate price, but in imperfect market, the producer becomes the price dictator. So in imperfect competition also, we have various types of markets. Monopoly, when there is only one producer and many buyers. Duopoly, when there are two producers, two sellers and many buyers. Oligopoly means there are few sellers and multiple buyers. And the most important one, the monopolistic competition. That means many producers and many buyers. And then what is the difference between monopolistic competition and perfect competition? In perfect competition, products are identical. But in monopolistic competition, products are not identical. There is a uh, small differentiation. So product differentiation is done to have a control over the price. Okay. And we have seen many examples like LED TVs of different brand have different features, but they serve same pro. So they are not perfect competitive market, rather they are a monopolistic competition market. We talked about the motorcycles of 150cc engine. Now different companies have 150cc models, but there is differentiation. Some have auto start, some have, two plugs. So they do small differentiation to control over the price. And now this type of competition is called monopolistic competition. But when the products are identical, they are perfect competition. Milk coming from Amul and milk coming from Mother Dairy, both are same. There is no change, right? So it is perfect competition. Uh, Now let's discuss very quickly what is money and banking theory, and let's have a brief introduction on the management. Now, money is a medium of exchange. You need to understand that when we were talking about the subject matter of economics, we dealt with production, distribution, market, and exchange. Okay. Now, for the purpose of distribution and exchange, it is the money which comes in picture. So we need to have proper understanding of money. Money, by definition, is nothing but the exchange of goods and services. So whatever money system now in today's era, we are living in e-money era. But there had been some evolution of this exchange system, right, in the market. So it started with barter system. I don't know how many of you have heard, but you talk with your parents. Some of you would able to get answer. In remote area, I remember in remote area, in rural villages, when we were kids, we used to buy something in exchange of some rice grains or wheats. Now this is what is called barter system, when you are actually not giving currency, but you are giving the some other commodity and goods in exchange of some other goods and commodity. Uh, so traditionally, in earlier time, there was no currency, there was no coin, there was no rupee or note. So people used to do exchange or not. Yes, economics was prevailing. The process of economics was happening. How they were used to, how they were doing this? They were doing this by barter system. So whatever commodity they had with them, then they used to exchange that commodity with something that they needed. For example, I am a farmer. My product is, the basic grains, may it be wheat, may it be pulses, may it be rice, and someone else living in the same society is a goldsmith. Now I need some gold ornament. Now what I have to do? In those time when there was no rupee, no currency, but goods and services were there, and the desire to utilize all this good service was also prevailing in among the consumer, among the population. So I will rush to the goldsmith and I'll tell him, look, I want this and I have rice with me. So we will exchange. I will give my rice to the goldsmith and he will give me a piece of uh, ornament which I want. Now this was actually happening as a medium of exchange in traditional time when we do not have the regulated monetary policy. This system was called barter system. Advantage, disadvantage. Let's talk about advantage. People yet used to exchange goods and service among themselves. You know, uh, we have something, we need something, someone else has something. Now whatever I have, that is something which may be needed by the other person, so we can easily exchange with it. But there is a lot of limitation other than this advantage. What is the limitation? Limitation number one, there is no unit defined to my product and your product. Your product may be costlier and my product may be easier, cheaper, but there is no unity. I mean, no value determined between, what quantity would be the ideal quantity. So that was one of the limitations. Second limitation, there are some things which cannot be broken. For example, let's see our example of goldsmith only. Now, goldsmith thinks a piece of ornament has a large value, right? Then the price, then the quintal of the rice which I am exchanging for it. But he cannot break that ornament into three pieces and get me one piece. So his product is not divisible. So that's the problem. And then the exchange is not happening. So that was the second limitation. There was no uniformity. There was no market or regulation कि इतना ही price होगा, इतनी quantity में ही आप exchange करोगे. Everyone used to do it as per need base. Okay, so to get rid of all this limitations of barter system, we evolved in bank monetary system, and the bank money came in picture. Now, what is this bank money? Bank money is the actual currency coins which bank publishes of the respective geography, which has a fixed value, fixed face value, and which helps, the consumer to buy the products in the market. It also helps the producer to store the money or fix the value of his or her product in the market. Then we came in the era of plastic money. Now, what is this plastic money? Plastic money is all your cards, credit card, debit card. You're not physically carrying the currency or coin with you, but you are physically carrying what? Cards. And the cards are swiped through the machine, and the money is automatically transferred from your account to the other person accounts. Maybe in 2 days, 3 days, he get the physical money in the account. So this is how, plastic money came in existence, and now we are living in the digital era where we are not even using plastic money, but we are using electronic money. So what is this electronic money? All your e-wallets. Now you don't even carry your credit cards, your plastic cards, you carry just your mobile phone. You buy something, there is a scanner, you scan the UPI code and the money is automatically credited to the producer's account and dated from your account. So this is how money has evolved over period of the time. Let's talk about the functions of money. The major function of money, as I told you by the definition itself, that money is nothing but it's a medium of exchange. So the primary function of money is having a measure, and working as a medium of exchange. So what should be the value of your goods in term of measure? Um, in term of exchange, how you will exchange goods and services, the producer and buyer. So they'll give money and the producer will get the good, no more barter. So this is the primary function of money, but there are some secondary function also. So what is the secondary function? The wealth creation store. It is the money which is responsible for the wealth creation of at individual basis or at large country basis. Then standardization. Money actually gives the standard value to all goods and services and all other factors, all entities operating in the market. So these are some of the secondary function of money. Now let's talk about the classification of money. Now, money can be classified as four different types of money. Standard money, number one, credit money, number two, fiat money, number three, and fiduciary money, number four. Let's talk about all this four with an example. What is standard money? Standard money in simple terms is all your coins and currency notes which are issued by the bank at respective time in a respective geography. So in India, we have currencies which are paisa or rupees. Now this is standard money for us. So all those money have the same value as it is depicted on the currency. So if a currency note has a value of 100 rupees, now this 100 rupee note will have same value, 100 rupees, nothing less, nothing more. Okay. When it comes to credit money, the credit money is something which you are not getting in a standard currency form, or if at all you are getting in a standard currency form, it is always less than its face value. Right? Suppose you go for taking a loan from the bank and you mortgage something. You mortgage your vehicle, you mortgage your ornaments, you mortgage your house. The lender will not give you the exact value of your article, but it will secure some of the portion as a security and the remaining amount will be lended to you as a loan. Now this is what is called credit money. So in standard money, the face value remains same. Whatever the amount which is written on the currency note, that is the amount which is with you. But in case of credit money, what happens, the face value of the money that you receive is always less than its actual value. I have given you the example of loans. Now let's move to the third type of money, fiat money. Now what is this fiat money? Fiat money is the money which is being issued by the government or on the direction of the government. Right. For example, during COVID time, what happened? Government has directed all the banks, many of the employers, public sector employers, that you have to give extra money to your employees. And in certain cases, government has also given the subsidies. So actually that money has not came because of your work or because of your wealth or because of your saving, but it was something which was given by the government. Now it can be the actual currency or it can be even the substitute replacement. For example, all the subsidized food grains which were given to the poorer, I think it is still continuing in our country. And it is as good as money. If they do not come to you, you will be spending or the consumer will be spending uh, currency for getting those needs fulfilled. So fiat money could be, the direct currency or anything in replacement of the currency. At times, for example, in certain countries, the government has legalized the cryptocurrency. Now you can do the transaction by using in blockchain. So that's a replacement which has been guaranteed by the regulator, by the government. So in that country, you can buy your needed article either by using your standard money or you can use it by bitcoins. You can use it by some cryptocurrency. Why? It has been it has been directed by the government. So whenever such direction comes, for treating anything else as a money, as a standard money, uh, then we call it as fiat money. There are some promissory notes which are issued by the government at time to time, right? So you get a simple sheet of paper which is not currency actually, but when you go and deposit it to the somebody else, they consider it as money. So again, this is what is this could be an example of fiat money. I remember in early 20s when the enough of note currencies was not possible uh, because of some economical issue, and the low denomination notes were actually not in good condition. So people used to have something, which had a stamp, a sheet of paper written as 5 rupees and there was a stamp. And the shopkeeper used to consider that note, that pay just a paper note, which is not a standard money, as a money, and they used to store it. Now this is again an example of fiat money. Government has given a direction that you can use some different article for the purpose of medium of exchange. As simple as this. Let's move to the last category of money. This is what is called fiduciary money. Now what does this mean? This means when you keep the money as just thinking, having the trust on the issuer. Like we live in a society, we have our neighborhood. Somebody need, something, but doesn't have money. But the person is trustworthy. So person gives you, do one thing, you keep my watch, right? And I need this, you please let me this. Now this watch here work as money. because it is working as medium of exchange. But actual standard currency has not been used in the exchange, but it is the trust which has been used. Okay, sometimes maybe what, sometimes even a word, de denge bhai, to de denge to de denge. Now such type of exchange, when it is happening, it is the fiduciary money which comes in picture. Okay, so we discussed about what is money, money concept, the evolution of money, and the money classification. You should remember all these four different type of money with an example at least. Now let's move to the monetary system. In India, the Indian monetary system is uh, regulated by our central bank, which is called Reserve Bank of India. Now, what is the basic functions of Reserve Bank of India? They frame policy with respect to managing the reserve system of the country. So how wealth will be reserved, how wealth will be created, how price can be controlled. All these policy related decisions are taken in India by a central bank. The second decision, second function, what it does, it issues the standard currency. So we talked about standard money in earlier slide, right? So how much of 100 rupee note, how much of 500 rupee note, how much of 200 rupee note has to be circulated at any given point of time. Now this prerogative is with the RBI. So all this policy related decision with respect to issuance of standard currency and the management of reserve system of the country is actually called as monetary system of any country. For India, it is Indian monetary system, and who is the agency responsible for managing the monetary policy? It is the Reserve Bank of India. Uh, let's talk about the how this money is being supplied. So first, what we understand by money supply. Money supply means total stock of money circulated and held by public at any given point of time. So RBI suppose has circulated in the month of November, 1 lakh worth currencies. 1 lakh currency has been circulated in the market, and already the entire population, our entire 130 crore population, have 13.4 lakh crore worth of currency available in the market. So what is money supply? 1 lakh currency circulated by the RBI, additional pumped, and what, 13.4 lakh, which is already with the public. Now, if you combine both together, it becomes the total money supply at any given point of time. What are the different components of money supply? Currency, the actual currency, and the demand notes. What is this demand notes? Demand notes, we talked about your classification fiat money. You remember fiat money? So any promissory note or any demand note which has been given by regulators. What are the sources of money supply? There are three important sources of money supply. For fiat money, the government itself or the directives of government on which the RBI considers to, increase the money supply, issue more currencies, right? The second source, RBI itself, custodian of the monetary policy of the country, head of the monetary system of the country, the Reserve Bank of India or central bank of any other country. We will talk about the types of bank later on. Now they are the important source of supplying the money at any given point of time. And the third one is commercial bank. How they does, we'll discuss when we'll come to the commercial bank. Now see, in case of commercial bank, they are not issuing currency. So they don't have a right to print currency and circulate in the market. Yet they supply money. How, we will discuss later on. Okay. So in money supply, you should understand the components part. What are the different components of money supply? And you should understand what are the sources of money supply and the actual meaning of, what actually money supply means. How can we measure this money supply? So there are three ways, three different formulas written over there. You can take a snapshot of this slide, self-explanatory. This is how money supply at any given point of time is measured. Let's move to banks now. Now, there are two types of banks, right? One is called central bank and the second one called commercial bank. Let's talk about both of them one by one. Central bank means the custodian or the agency that regulates monetary policy. So the authority which is the head of the monetary system of any country is what is called central bank. And what is the function of what is monetary system? It is issuance of currency and it is uh, storing the wealth or creation of the wealth. Both are one of primary function of the monetary system. Now, who is the authority of this monetary system? It is primarily the central bank. So central bank is also called as money base because the entire issuance of the currency, controlling the supply of money is within the hand of, the central bank itself. So often it is also called as money base. Now in India, we have Reserve Bank of India, which acts as central bank, not the Central Bank of India. Don't get confused with the terminology central bank with the Central Bank of India, which was established in 1935. So with this, you should remember the year 1935 and you should remember central bank. RBI is our central bank. And you should, in your manual, the detail about the RBI Act is given. Please go through it. Self-explanatory, need not to, does not need too much of explanation over it. So you are requested to go through the entire RBI 1935 Act, which is very important. So central bank in India acts as uh, is acted by Reserve Bank of India. Now, what is the function of central bank? That is more important. There are three functions of central bank. First, currency related function. That means it issues the standard money. So whatever money is in circulation, it is because of the issuance of the currency at any given point of time by the central authority, that is monetary system head, that is money base. The second one, it also act as vault of commercial bank. So we'll talk about what is this commercial bank. So where bankers, whenever bankers need some money, they can approach. They can approach RBI and RBI serves as vault of all commercial banks. And the third function is it also holds deposits of government and the commercial bank. Okay, so with it acts as custodian of all the money of the government, regulatory agency, and all the commercial bank. These are three primary function of Central Bank of India, RBI. Now let's move to commercial bank. Now, who are commercial bank? Commercial banks are actually the public interface of central bank. So for day-to-day exchange purpose in the market and the need of money, or money related activity, the normal public cannot go to the central bank. So there has to be an interface where day-to-day monetary related needs can be, fulfilled between the public, between the consumer and the banker. Commercial bank comes in between. So they are intermediaries. They are the interface of central bank. What they do? Their primary function revolves around five different important function area. The first one, deposit. They take deposit on behalf of public. So whenever I have excess money, I want to keep it. Where I can get chori ho jayega, let's put it in the bank. Okay. So they, one of the function of the bank is they become the custodian of your saving. They accepts the deposits so that it is in safe and you are secure. The second one, they also offers loan. In crisis, whenever you need something extra, some money which excess, then which you are not able to fulfill, so you need some lending. Banks come in picture, all commercial bank come in picture, and they are ready to float, loans to the consumer, depending upon the consumer profile, of course. The third function, they serve as agency. Like if you have to transfer money from your account to someone's other's account, but the other person is not having account in your bank, some other bank, your bank itself would able to transfer the money to the person. It also helps in collection. So on behalf of governments, if you have to, deposit some tax, now you will not reach to Ministry of Finance and you will deposit your tax. It is the bank which will come in picture and you can pay your tax over there. So these are agency function which are also done by the commercial bank. Let's move to the fourth function, general utility services. Now what is this? Suppose you are moving from India to US for a holiday trip. Now there, your rupee will not function. There the standard currency is something else, dollar. So you can go to your commercial bank, you can request for traveler's check. They will issue a traveler's check for that donation destination depending upon your requirement, and you can use that traveler's check as standard currency when you are reaching to there. So these are some general utility services. Other example would be issuance of check. Now, when you are paying some bill through check, actually you are not giving the standard currency. Before that, you have to reach to the bank. You have to take out your the amount from your account, and then you can physically hand over it. Instead of that, you issue a check. You write the denomination on a check and you sign it, which is backed with the authenticity of your bank, your commercial bank, and you submit that check. It is considered as the payment has been done. So this utility services, this issuance of check and acceptance of it is also something which comes under general utility services. They also offer at times lockers. Now you have at your home you have ornament and you are worried about all those things being theft by someone. So you can have a locker service in the bank and you can keep all your valuables there so you're mentally secure. These are general utility services, which is also an important function of commercial bank. And let's come to the last one, money creation. Now this is what I was telling you. We'll discuss about this when we will come to the commercial bank. When I was telling you the source of money supply, there were three sources. Look at this slide. Government, number one, Reserve Bank of India or central bank. Number two, the third one, commercial banks. Now, RBI has the authority for issuance of currency. We can understand that money can be supplied by them. Government can issue fiat money. We can understand that it can be supplied by the government. But how this commercial bank is doing? So let's understand this with the fifth important function of commercial banks. And what is this? Creation of money. Now, commercial bank, though they cannot issue currency, but yet they can create, money at any given point of time. How? Let's say an example. Suppose I have 5,000 rupees with me, out of which I need only 3,000 for my total expenditure of the week, and I have 2,000 surplus, which I don't need. So what I do, the first function, I deposit it to the bank, my bank. Like me, 50 other peoples are there. They also don't need to have their excess money, so they also deposit that money to the bank. So now 50 of us have deposited 2,000 each. How much it becomes? 50 into 2. So it becomes around 10,000 or what? Around 10 lakhs, 1 lakh. Now this 1 lakh of amount has been deposited by all 50 of us in a bank. Now this was the surplus money which was with us. So bank has now 1 lakh of rupees. OK. Now there is another, you go to the bank and you say, look, I want to buy a refrigerator which cost me 20,000, but I don't have 20,000. Can you please give me a loan? So bank will give you a loan. From where the bank has given you the loan? It is the 1 lakh rupees which has been deposited by we 50 people in the bank. Bank has not issued any currency, but it has already a surplus, a 1 lakh rupees is there with the bank. So bank is giving you 20,000 rupees of loan. The problem comes कि ये default हो गया तो क्या? So bank will mortgage your refrigerator. So there is a security. The value of your, I told you credit money is always less than the face value, actual face value. So the refrigerator is worth 30,000, but you have taken loan only 20,000, but the refrigerator is being used by you, but the owner is, it has been mortgaged by to the bank. So bank has your refrigerator, which bank does not have physically. It is physically with you, but it has value around value of that refrigerator around 30,000 of value the bank has within its custody. So 1 lakh rupees, out of that 1 lakh rupees, 20,000 bank has given you. That excess 20,000 circulation came in the market, number one. Number two, if you fail, then tomorrow 50 of us, we reach to the bank, where is my money? How bank will pay? So they has also, parallelly mortgage your 30,000 worth of, commodity, uh, which will remain in their custody until unless you do not give them back. Now see how much money has been created in this entire process. 20,000 loan given to you, 30,000 worth asset, that asset is again in the hand of the bank, on basis of which the wealth of the bank has increased. It has just lended 20,000 go off from its deposits. Out of 1 lakh, 20,000 gone. So it has still left 80,000. There it has increased the liability on you of 20,000. So 80 plus 20, again 20 became, and it has further added 30,000 of asset in his account. So this 30 plus 20, 50,000 extra money creation has been done by the bank. This I'm talking of just one unit. If you put it on the larger scale and considering all the banks, which is one of the important function of the bank, giving loans, right? So by this, they are creating money. Uh, Now, I think with this, now the details of it is already there in your manual, so you can go through it whenever you get time. Nothing much is much is needed to explain on this. So with this economics parts of your paper 4, we have covered. We have discussed all 4 areas: production, distribution, exchange, and market. Uh, in note in your study manual, everything is described in detailed manner, so you will not have any problem. Still, if you have any problem, you can get back through text. Uh, let's move to management now. So in today's session, we will not deal with the entire part of management. We'll just have the introduction part. Just a moment. Okay, just a moment. Okay, I'm sorry, system hang up. Uh, so let's quickly discuss about the concept of management. Uh, Management means bringing human being and resources together for effective and efficient utilization. Uh, Important inseparable part of the process of economics. If you remember when we are talking about factors of production, there were four factors: land, labor, capital, and organization. Now, what is this organization? Here, the role of management comes in picture. How you are utilizing all these other factors for for bringing economics of scale, that means efficiently and effectively, and also to meet it your end result is actually what is management is. Without management, it is not possible for any economist to meet the all needs, all human needs with limited resources. So it is the process by which, the needs can be met even with the limited resource. There are two words, meant and man. So management primarily deals with the process of bringing human being together, man together. How you are bringing human being at work one place, how effectively you are channelizing with them, how you are utilizing their human effort, you know, along with the resources, the raw material, the geography, to fulfill the predefined objective of meeting the need is actually done by the management. Is it something new which is prevailing in the modern education? No. Uh, at your house, your mother is managing your home effectively, right? So your mother is controlling all over you, family members, giving you instruction, taking care of your needs, and also utilizing your efforts for, all the domestic chores. Now, all this can be a simple example of management. But in business, when we take it on the larger context, then this management becomes one of the primary function. Okay. Before we go through it, let's understand the evolution of the management, how the study of management evolved over period of the time. We are more interested in the modern management evolution, not from the ancient time, but we are interested in the evolution of management as a subject matter in our education system so that it help, the business. So we will talk about four important management evolution theory. The first one, the classical theory of management. If you have notepad and pen, you can please note it down. The second one, behavioral theory of management. The third one, system theory of management. And the last one, MBO, management by objective. Okay. And there is fifth one more, but that is actually in between behavioral theory and the system theory of management. You can write it down. It contingency theory of management. So management over a period of time has evolved from neoclassical theory of management to today's time, system theory of management or management by objective. Let's understand all these 4-5 important theory of management. Starting from neoclassical theory of management. After first industrial revolution, what happened at production facility, there was advent of new technology, new machines. So though this new technology and new machines were deployed in the facility, but the workers who used to work for the company for the purpose of production do not had enough of understanding of utilizing those machines. So in spite of investing heavily on this new technology, the output producers were not able to, get the desired output. As a result, a new management theory came in existence. We call it as neoclassical theory of management. You should remember few important personalities whose ideas were framed as a theory and whose work were the major contribution in neoclassical theory. The first name comes Adam Smith. We talked about Adam Smith in wealth definition of economics. If you recollect, money is the process of creating wealth, right? So first name comes Adam Smith. The second one, F.W. Taylor. He has given a management theory called scientific management theory. Uh, so his views were also the views responsible for devising this new management process, which is called neoclassical theory of management. And another name that comes in picture is Henry F. Fuel, HF Fuel. So these three gentlemen's idea were conceptualized and formalized into a new management approach, which is called as neoclassical theory of management. Now let's understand the feature of neoclassical theory: evolution, history, and credit. Now let's come to the evolution, the features part. What is this neoclassical theory of management? Neoclassical theory of management suggests, number one, for any organization, for any producer, for any process to meet its end result, there are some primary functions which has to be done first. Number one, take the experience of expert of the field and train the people first. This is what even FW Taylor suggests, process of scientific management, lot of emphasis on training. So you can't expect just by installing new technology or bringing a new machine in your production facility that your output will increase. First, what you have to do, you have to skill your worker. Those people who are going to handle this machine, those people who are going to utilize this technology, they should have full access to this technology and they should have full understanding how to access this technology, how to use this technology for increasing their efficiency. So the foremost important thing is that we need to hire the experts of this technology so that we can train our existing employee. So the fundamental feature of neoclassical theory of management is what? Get the help of the experts who are rich experience and are key opinion leaders of their respective field. And then the second one, train the people before assigning the work. You can straight away ask the worker, go and from tomorrow onwards, you have to run this machine. No, you have to train the worker first. Otherwise, you cannot intend to reach to the ultimate output. Let's move to the third feature. The third feature is, in an organization, you may have 10 employees. Now, efficiency of all 10 employees are not same. As I told you, the problem with labor is what? You cannot segregate labor with the laborer. So one person may be able to give you 3 units of output. One person may be 5 and one person may be just one. One person not even able to give you even the one. So different human beings have different human effort. Different labors give different labor. So this theory suggests, this feature suggests us those who are giving extra efforts must be incentivized. Now it is injustice on their part. No, there are 10 employees who are working in a company, in an organization. All 10 of them are getting 10,000 rupees each. But one person is giving you 5 units of production. Another person is giving you just 1 unit of production. So what is the morale of the employee who is giving you 5 units of production? So it is very important as a manager, as a management, that you must recognize this extra effort and you should just not recognize, but you should also award this extra effort with incentives. So the third feature, the most important one, incentivize performers. Those who bring extra result from the benchmark, they need incentives. Incentives are the need. It is just like a carrot. Once you announce this, now employees becomes awake कि यार 5,000 सैलरी तो आ ही रही है, अगर ये 3 की जगह 5 कर लेंगे तो 1,000 रुपए शायद एक्स्ट्रा मिल जाएंगे. So there is a carrot in front of your employee and they bring more effort. They bring more effort leading to more output. The next one, giving incentives is okay, but what about those employees who are not even worth bringing 1 unit when your average unit of production is 3? So there are some employees who are pulling down your production. Now these should be shown stick. So the fourth feature, which is important one, those who not even bring at par result, forget about bringing result which is equal to 5 units. The extraordinary performance, they will get incentives. But if they are even unable to bring the average result, which is 3 units, they should be penalized. So the fourth feature suggests of neoclassical theory of management, incentives for performance, third one, and the fourth one, penalties for non-performer. Those people who are unable to bring even the average result, they need some penalties, they need some punishment. What should be punishment? It could be just a reprimand. It could be, an inquiry. It could be a suspension. It could be seizing down some facility, or at the last, it could be even cessation of the employment. Right. So bring the experience of expert, train your employee, incentivize the worker, and penalize the people who do not, bring even at par result. And the last feature, which is also the important one, is called in case of conflict, the objective, the view of top management or the entrepreneur will prevail. Now, what does this mean? Suppose I have an idea, right? I'm an employee of working in company X. So I have some understanding, I have some issues, and the organization has some other idea. Now we both discuss, and when it reaches to conflict, as per neoclassical theory of management, in this condition, the idea of organization will prevail. Do hell with my idea. So there is no voice, there is nothing to be appreciated about the employee in case of conflict. It is the ultimate decision of the authority, I mean the management, which will prevail. These are five of the important features of neoclassical theory of management. Advantage and disadvantage. Let's talk about advantage first. Advantage, you train the employee and then you ask them to work. Obviously, you are going to get more efficiency, more results, so better output. Second advantage, you incentivize people. People are mentally healthy. They bring more effort. They know that my extra effort gets some incentives. There is further enhancement of production. Efficiency increases. We meet the end result. Next advantage, you impose penalties, then people are scared of the penalties. Ultimately, they at least come to bring the at par result, efficiency increases. So in one word, if you see what is the advantage, it's a powerhouse, neoclassical theory of management, which tends to increase the productivity. So ultimate advantage is the productivity or the output of the organization always increases if the organization incorporates neoclassical theory of management. So uh, all gold sides do not have just brightness. There is some silver lining also. So there is some disadvantage also. What is the disadvantage? The disadvantage is feature 5. And what is this? In case of conflict, the organization decision will prevail is something which is disadvantageous for the organization. Why? You can prevail your view on the employee for once, for twice, for 10 times, and then what happens? Then people start moving out. My value, I don't have any value, my opinion doesn't matter. They search for the job and they quit your organization. So that is the biggest advantage. There is high turnout. If any organization 100% incorporates neoclassical theory of management, take it for granted, the employees turnout would be highest in that organization. And if employee turnout is highest, ultimately it is impacting your efficiency only, the output only. लोग आएंगे चले जाएंगे, पहले तो सीखेंगे, जब तक हम सीखेंगे रिजल्ट लाएंगे, 10 दिन रिजल्ट लाएंगे, फिर बाहर चले जाएंगे, यार यहाँ कुछ सुनता ही नहीं. So that was one of the major disadvantage of neoclassical theory of management. Now this disadvantage led to the evolution of second theory of management. We call it as behavioral theory of management. You should remember a few names. One is Alfred Marshall. You remember law of diminishing marginal utility, law of supply, law of demand. All this theory came from Alfred Marshall, one of the greatest socialist economists in, in the subject matter of economics. And the second gentleman was Eric Trist, the American American management consultant, Eric Trist. Now, these two gentlemen uh, had a different view from the neoclassical theory. Yes, they stressed on the training part. They agreed that organization or management is all about bringing efficiency, but they consider the organization, employee, and the office as a interdependent relationship set of system where both spokes are important, both ends are important. You cannot impose your idea. You cannot take just one way of decision. So this behavioral approach came in picture. A brief background about it. After First World War, you see in Europe continent, all the countries share their neighborhood with each other, and they're very small in nature. So there is a lot of immigration. We have European Union for that purpose. That means if you are staying in France and you want to work in Germany, there is no separate permission needed. You can easily, cross the border, you can reach there and you can work in the office, and at weekend, Friday night, you can come back to your hometown. Uh, so trans-border immigration is quite smooth. It is open, and therefore you will oftenly find in these countries, in France you will find a lot of Italian working, a lot of Germans working. In Germany you will find a lot of French working, a lot of British people working. So all these neighboring countries people, they gather at one place and they work. Now, in this case, what happens, we share different culture, we different social belief system, our value system, our understanding are different. But when we assimilate and work together at one common point, at one workplace, and the management has some different understanding, value system, behavior, social taste and preference, then what happens? Uh, as a human being, we also want to satisfy our emotional needs or our social belief system, but organization is not letting us to do so. Why? In case of conflict, the organization's decision will prevail. So as a result, people started, leaving the place, and there was a lot of scarcity of the worker. Now, this was the reason why behavioral theory came in picture. And what now behavioral theory suggests? Let's talk about features. It accepts all the views of neoclassical theory that you need to incentivize, you need to penalize. It also stresses on the training part. So F.W. Taylor, Henry Fayol, everyone is accepted, but it criticizes, that the decision making has to be just one-ended. Now, what does it suggest? In case of conflict, you cannot impose the idea of being manager to your employees. Rather, there has to be a proper discussion, amalgamation, association between both the ends, and the view and the opinion of both party is important for the organization, which will bring social harmony and intact the people to work together. So at times, if the organization has to scale down their idea, they have to do it. At times, if even employee has to scale down the idea, employee also has to do. You cannot be stubborn on your idea. And since you are stubborn, the employee is leaving your organization. So have a hybrid system where behavioral aspect is exercised in such a way that the emotions, value, social belief system, uh, the emotional balance of worker are well maintained. Excellent idea which was brought by behavioral theory. Advantage, retention, self of belongingness. Now, if you have such a culture, such an environment prevailing in the office or at your workplace, you'll not like to leave the organization just for a couple of rupees, maybe just 10% or 15% hike, right? You would tend to work there. Okay, you have a sense of belongingness, and in emergency, in crisis, if the organization asks you to do extra effort, you're okay with it. So that's the advantage of behavioral theory of management. Disadvantage. Let's talk about disadvantage. By and large, labor, worker, we are human beings. So there is a tendency of having good, parental care done by the employee or the management. We become lazy. And in long run, if this behavioral theory of management prevails, in long run, there are chances that the output may get impact. Why? Because the organization is tapering down their objective. They have set an average of 3 units production for everyone. People are not happy. There is some problem. Uh, they take undue advantage. Now there is no refreshment, so the employer has, kept 10 vending machines, tea vending machine, coffee vending machines, and etc. Employees are taken for granted. Now let me take a ride of this. So ultimately, what will happen in a long run, because of our human nature, because of the human nature of the people, in long run, there are chances that it may impact the efficiency. It may not serve the ultimate objective for which this theory was incorporated. So let's come to the get rid of the third problem. So third problem, get rid of the third problem. Deming, gentleman from Japan, he come up with a new idea, which we call it as system theory of management. So let's understand what is the system theory of management. You must have heard about Six Sigma. So the mother of Six Sigma is system theory of management. Now, what is this system theory of management? Systems theory of management brings an entire new paradigm shift to the previous two management approaches. That means whether it is neoclassical approach or behavioral approach, the system theory of management changes everything dynamically. It brings a new paradigm shift in it. So what is this? System theory of management suggests that organization is just not set of people or the equipments, the resources. Rather, the organization is just like a human body. Uh, so in our body, we have different organs. We have our brain, we have our heart, we have our stomach, so forth and so on. If all these organs are coordinating well with each other and working properly, then only we are okay, we are healthy. Similarly, in organization, there are different components. We call these components as systems of the organization. That's how this word system theory of management came. Now, suppose there is some problem in your heart and your stomach is 100% perfect. Your brain is 100% perfect. Your legs and hands are limbs are okay. Still, you will find yourself unhealthy. Still, you are not comfortable. Still, you are not able to do your routine work. Why? Because there is one organ which is not working properly. Though the majority of the organ in your body is okay, there is no problem to it. It is absolutely wonderful. Right, still you are uncomfortable. Same thing happens in the organization also. If we do not diagnose the problem happening in one system, it may have repercussion on the entire organization. So for understanding, in system theory of management, the organization is categorized in four subsystems. Let's understand what is this four subsystems. The number one is input. So raw material, human being, technology, everything is called input. The second one, process, assimilation of all this input and coordination of all this working together for the purpose of producing something. The third system is called final product. So what they are working for, what is the end objective, what is the end product? Okay, finished goods. And the last product is for whom this product has been produced, outcome, the consumer. Now, till the time the people were only interested in neoclassical theory or behavioral theory, they were only considered in getting maximum of the finished good, just one entity, one subsystem, product, product, and product. But in this case, what system theory of management suggests, you may have good number of product, you have high productivity, but with your productivity, your customers are not satisfied. Now you cannot control the satisfaction of your consumer sitting in your factory. It is something which has to be tasted and satisfied by the consumer itself. So there is a problem of outcome. People are not satisfied. Still, it will have the repercussion on the entire organization, and in long run, your organization may not able to reach to the predetermined goal. So you also have to address the outcome. Let's say another example. You have wonderful skilled worker. You have best of the equipments available in your factory, but there is some problem in the raw material that you have procured. So there is a problem of input. This input has been processed, very well packed, finished goods. You got it, but your machine, tampered because of this bad input. Now, where was the issue in the machine? No, the issue was there in the input. And what you are rectifying your machine. So for this purpose, system theory of management suggests identify the problem prevailing in which of the system. May not be the result which you are getting in any of the system is because of the problem of that system. May it be possible that the problem exists somewhere else and you are giving solution to some other system. So it's stress on the identification of the problem first. Then it talks about identification of the solution of the problem. So once you have identified the problem, now identify the solution. There is a problem with the input. What is the solution? I have identified the solution. Now your work has not yet been done. तो problem भी identify हो गया, solution भी निकाल दिया, हो गया ना काम. Now you see whether this solution is complementing other subsystem. Solution तो input का हुआ है, लेकिन इस solution से क्या बाद में problem आ सकती है manufacturing में, equipment में, customer का satisfaction retain हो पाएगा या फिर बिगड़ जाएगा. So it talks about 360-degree coordination among all the subsystems of the organization. The real manager is one who is able to coordinate all this subsystem well. That's what is system theory of management. Very dynamic in approach. It speaks about proper coordination of entire subsystem, which also considers the extrinsic factor like consumer. Right? That's why you will find when it comes to quality, this Japanese theory, Deming's system theory of management, when it comes to quality, nothing works like Japanese food, Japanese goods and service. 15-20 years back, what happened? There was a problem in Toyota car, one of the batch, which was identified somewhere in Australia. And it came to the attention of the management of the Toyota itself. What they did, they brought back 4.5 lakhs of Toyota car across the world. The experience was not with all the consumer, it was with only one consumer. But since it may have the repercussion, see how they work. They identified the problem. Problem is with the customer satisfaction. They identified the problem, brought back the entire batch, and they replaced it. So that's how when a management works on the system theory of management, they see that all the subsystems of the organization, whether it is intrinsic, extrinsic, whether it is technology related, whether it is output related, they are well coordinated. Not only they are well coordinated, whenever there is a problem in any subsystem, the real problem and the root of the problem, we don't give solution to the subsystem, but we try to identify the root cause. Where is the root cause? Is it in the subsystems or it is in some other subsystem? And then it speaks about the solution which may be complementing other subsystem. So we have identified problem, now give the solution. No, we will also reassure and recheck whether this solution is also helping other subsystems or it is just addressing the problem of input. Wonderful theory, dynamic approach of management, and in most of the company, even as on date, the system of theory of management is implemented and it gives effective result. Okay. Now let's talk about contingency theory of management. What is contingency theory of management? Now contingency theory of management speaks about adaptability. You can manage people which are under your control. So you can manage your employee. You can manage equipment, machines, resources which are under your control. So your infrastructure, your facility, all this can be managed. But what about the things which is not in your control, which are extrinsic in nature? Suppose tomorrow government imposes a GST of 24%, what you will do? So contingency theory of management suggests a manager has to be aware how to adapt with external change. Efficient manager is not one who only effectively and efficiently utilizes the internal resources, but is also one who can adapt well, because with external factors you cannot utilize it, you cannot control it. What you can do, you can adapt yourself to the external factors. So great managers are the people who adapt themselves to the external changes. Okay, that's what is contingency theory of management. Let's move to the last theory, that is called Peter Drucker, father of management, management by objective. In his book Principle and Practice of Management, this gentleman stressed upon management as a process of setting goals, mutual goals. So the theory is called as management by objective. Now, what is this? Normally, what happens in any organization when you are working, it is your boss or the head of the department who gives you assignment, targets, objective. Look, in this company, you are supposed to work for this hours, and in a day you have to produce 5 units or 10 units. Now this unilaterally or one directional target setting is the real cause of the problem. So real manager is one who before giving or setting this target involves the employee itself. So Peter Drucker suggests that goal setting process has to be two-way, not one way. Okay, so you cannot have a blind idea based upon your experience that, okay, in 8 hours in my office, normally people bring 3 units. So let me set 5 units. Rather, you have to bring the actual executor, the employees who are about to bring those 5 units on the dais, and you both first discuss, look, I am thinking of increasing the production average unit from 3 to 5. Would you able to do it? Let the opinion come from the executor. Naturally, executor will resist. Now, in case of resistance, the executor will resist and you have to sell the logic to the executor. Resist करेगा नहीं हो पाएगा. तो आप एज ए मैनेजर बताओगे ना यार पिछले के पिछले हफ्ते तुमने तो 7 किया था हम तो 5 ही कर रहे हैं. Right? So we will have, logic sharing exercise, not by authority, but by rational. कोई experience हो, उसके पीछे कोई science हो, कोई logical arguments हो, then both party will argue with each other. अब वो बोलेगा अच्छा वो तो हो गया था 7 का, मैं रात को 12 बजे तक बैठा था, चलो 4 कर लें. Like this, there is a proper discussion, two-way communication which is happening between the manager and the employee. Point where both agree, that becomes the target, and then it is given to the employees to work upon. Now, what is the advantage of such an approach, MBO? The advantage is the accountability increases manifold. In earlier case, when you as a boss are giving your employee target of 5 unit, it is something which is imposed. But in this case, when you are having mutual discussion with your employee and then you are fixing 5 unit, it is something which is not imposed, but something which has been taken. In the entire process, the employee is participated the discussion. He has his opinion. He addressed all his misconception, even if he has taken the inflated targets, because he is convinced now. You have given the rational, you have given scientific discussion, you have brought the logic, you have given the experience, and the employee is well satisfied, convinced. So it doesn't sounds to him as if his boss has given the target. Rather, it feels to him as if he has taken the target. Accountability increases manifold. When accountability increases, when you are willing to do something, then the job of manager becomes quite easy. So that's the advantage of MBO. Prevalence, yes. In today's recent time, in every organization, there is a mix of all the approach which is implemented as a management policy. Incentivize, penalize training from the neoclassical theory of management, goal setting from Peter Drucker's MBO, solution or identification of problem and bringing efficiency from the system theory of management, adapting changes with the external changes from the contingency theory of management, creating a social subunit from the behavioral theory of management, and that's how it is mix of all this traditional but the most important fundamental modern 5 management theories which is bringing results in any great organization today. So tomorrow after becoming CMA, when you are going to head the organization, please do not implement any of this theory in totality in your organization. Rather have a hybrid approach. Whatever is needed, extract it from the respective theory and make sure that you are able to bring your people and your material together to bring efficiency and effectiveness in your organization. I think with this, that would be more than enough. More than this, human brain don't have the capacity to tolerate. So we'll discuss all the functions of management, the leadership style, management organization, all this aspect in our last session. I think this entire material is available on the team, so you can download it for your reference, and please go through the study notes of your manual. So from my side for today, that would be enough. Thank you very much. Read well. Next month you have exam, so read well, do well. Anji.
Yes sir.
वो मेरे तरफ से हो गया. देखिए हो गया टाइम, 2 घंटे से ऊपर तो नहीं हुआ?
नहीं सर.
ठीक है.
ठीक है सर.
हाँ तो एंड कर लेंगे, मैं मेल कर दूंगा रात को.
ओके सर.
यहाँ से अपलोड नहीं हो सकता क्या?
यहाँ से तो नहीं हो सकता, आपको मेल करना पड़ेगा सर.
ठीक है, मैं मेल कर दूंगा.
हाँ ठीक है सर. हाँ सर.
एंड कर दूं मैं?
एंड कर दे रहा सर.
हाँ.